Welcome to this explainer. Look, today we are radically shifting how you view financial leverage. Based on some absolutely fascinating deep dives into anonymous financial expert reports, we're going to deconstruct the strict structural mechanisms and the behavioral algorithms required to actually establish real business credit. We aren't looking at credit as some kind of safety net here. Instead, we're analyzing it as a highly specific mathematical system. A system that's literally designed to shield your personal wealth while allowing you to aggressively scale your operations.
So, here's our roadmap for today. We'll start with the paradigm shift of viewing credit as leverage. Then, we'll hit the structural prerequisites, the mechanisms of predictability, behavioral algorithms, fractional reserve dynamics, and finally, wrap up with the compounding output.
All right, let's dive straight into part 1, paradigm shift, credit as leverage.
Expert analyses make it super clear that mastering this whole system begins with fundamentally stripping away the emotional baggage we normally attach to debt. Structurally, business credit has to be redefined. It is not a liability meant for financial survival when times get tough. Actually, scratch that, it's the exact opposite. It's strategic leverage. We're talking about the highly calculated use of borrowed capital to build a financial reputation, acquire income-producing assets, and scale, all while your own liquid cash reserves sit completely untouched.
You see, the underlying mechanics here are entirely different from personal borrowing. Consumer credit is historically used to buy depreciating assets, things like luxury goods or a new TV, which mathematically erode your wealth through interest. But business credit, that operates as an algorithmic lever. You take on debt specifically to acquire assets that produce positive cash flow. When done right, this entirely outpaces the cost of borrowing and signals intense, documented reliability to your institutional partners.
Moving right along to section 2, structural prerequisites.
Now, you absolutely cannot access this lever without a rock-solid, non-negotiable foundation. The system dictates a rigid 3-step progression. First, formalizing the legal entity, like setting up an LLC. Second, securing an employer identification number, or EIN. Think of this as the business's unique social security number. It's the ultimate identifier for tax and credit purposes. And third, establishing a strictly segregated business bank account linked exclusively to that EIN. If you skip even one of these steps, the whole machine breaks down before it even begins.
And guys, notice the absolute legal severity of commingling funds here. Financial reports emphasize over and over that mixing your money destroys the systemic barrier between your personal liability and your business operations. In the legal world, if a court sees no real distinction between your personal wallet and your business account, the corporate veil is pierced. Suddenly, your personal assets, your home, your life savings are entirely exposed to catastrophic operational risk. That separation, that is your ultimate shield.
But beyond just legal protection, this strict separation is quite literally the only way a business can demonstrate organized, consistent cash flow. Expert reports highlight that during recent economic crisis, countless businesses were denied relief loans. Why? Well, it wasn't because they weren't making money. It was because without a dedicated business account tied to an EIN, their finances were just too disorganized. They simply could not satisfy the rigid data requirements of institutional lenders. Proving revenue was structurally impossible for them.
Okay, let's get into section 3, mechanisms of predictability.
Once that infrastructure is built, systemic observation reveals a very direct cause and effect relationship that actually triggers lending. The financial action of opening an EIN-linked account automatically outputs a distinct corporate identity. Depositing consistent revenue outputs documented proof of historical cash flow. And complete separation of funds outputs preserved liability protection. You are basically feeding banking algorithms exactly the data points they are hardwired to reward.
Which naturally leads us to a pretty fundamental question. Why do banks actually approve business credit lines in the first place? It's a non-obvious but incredibly critical detail. that banks absolutely do not lend capital based on the intelligence of the borrower, the passion behind your project, or the brilliance of your big idea. The system does not care about your dreams. It cares about data.
The entire lending mechanism is governed by one thing: predictability. Lenders base approval strictly on how trustworthy a borrower's repayment history appears on documented paper. Capital is deployed only when historical data guarantees the repayment system is completely sound. You are essentially proving to a highly specific mathematical model that your enterprise operates as a zero-risk entity, producing inputs that consistently generate safe returns for the institution.
Which brings us to Section 4, behavioral algorithms.
So how exactly do you prove zero risk? By operating flawlessly. Expert outlines dictate some very rigid rules for credit management here. Keep your overall balances exceptionally low relative to your limit. Pay monthly statements in full, without exception. Never spend unbacked capital you don't currently possess, and use credit exclusively for documented business purposes. This isn't just friendly advice, folks. It is the exact behavioral input required to trigger automatic systemic trust from lenders.
To pull this off, you need a specific mental model known as delayed settlement debit. Basically, you treat your business credit limit not as free, newly printed money, but as a debit account with a deliberate 30-day time lag before cash is actually deducted from your reserves. By reframing it this way, you mathematically neutralize the risk of high-interest debt, all while passively generating a flawless, highly attractive repayment history.
Let's zoom out a bit for Section 5, fractional reserve dynamics.
To really turn credit into immense leverage, you have to understand the macroeconomic incentives of the institutions providing the capital. Under the fractional reserve banking system, banks use deposited funds to create new loans, holding only a tiny fraction in reserve. This repeated lending expands the broader money supply. And because institutions generate their maximum profit strictly through loan interest, they are fundamentally almost desperately motivated to extend credit. They want to give you money, provided your system is legitimate. A really deep analytical read of the economy reveals a pretty stark choice. You can hold idle capital, leaving your money sitting in cash accounts where inflation silently and gradually eats away its purchasing power every single year. Or you can align with the banking system's core incentives using strategic debt. This means leveraging bank loans to acquiring appreciating, cash-flowing assets that actually protect your wealth and outpace inflation. By understanding the bank's mechanisms, you use their own profit models to build your wealth. It's a real game changer.
Finally, we reach Section 6, the compounding output. When the structural prerequisites and your behavioral algorithms totally align, you unlock a massive snowball effect. A mature business credit profile systemically forces down interest rates on future loans simply because your risk profile is mathematically lower. It unlocks highly favorable payment terms from vendors who view your history as undeniable proof of reliability. And ultimately, it provides the massive liquidity necessary to aggressively acquire scalable assets without touching your own cash. As the expert reports note, strong business credit signals profound reliability. Establishing this distinct, robust financial profile allows the entity to grow, secure financing, and acquire assets entirely independently. It creates a total firewall, completely shielding the owner's personal wealth from the day-to-day operational risks of scaling a business. The complete life cycle of business credit essentially functions as a continuous mechanical loop. Step 1, implement strict entity separation. Step 2, prove your algorithmic reliability through flawless repayment behaviors. Step 3, access the institutional leverage that banks are heavily incentivized to provide. And Step 4, use that leverage to rapidly scale income-producing assets. But listen, maintaining this entire ecosystem requires 100% commitment. Literally, 100%. You must be absolutely ruthless about keeping personal and business finances strictly separated.
A single mistake, like paying a personal electric bill from your business account, can contaminate the data, compromise your legal liability protection, and instantly reset your predictability score with lenders.
So, I want to leave you with this final critical question. Is your current financial infrastructure properly optimized to turn structural credit into compounding operational leverage? Before you acquire your next asset or apply for any new capital, you really need to critically analyze your foundation. Is it built to survive a systemic audit and feed the banking algorithms exactly what they want? Or are you unknowingly commingling funds, confusing lenders, and exposing your personal wealth to totally unnecessary risk? The mechanics are clear. How you implement them is completely up to you. Thanks so much for joining me for this explainer, and I will see you next time as we continue to decode the systems that drive true success.